Hello, in this lecture we're going to talk about work and the labor market, chapter 17. We'll start off with our quote from Voltaire, who was a French writer, philosopher, and historian, and his quote is, "Work banishes those three great evils, boredom, vice, and poverty." So obviously I think this quote, a bit of it was a bit sarcastic here, but at the same time any kind of joke or any kind of sarcasm has a grain of truth in it. And so when we think about work does banish boredom in some ways, or at least transposes the boredom or moves it to some other type of boredom, possibly, depending on the type of work, or it could be a very exciting thing. Vice, the idea, of course, being that if someone is working, they're less likely to be doing things that are viceful. And poverty, hopefully, if we're getting a decent wage, the work will lower the poverty. So chapter goals will be to explain how the supply of labor is determined, explain how the demand for labor is determined, explain how wages are determined by both the supply and demand for labor in combination with social forces, contrast three types of discrimination that occur in the labor markets, and summarize evolving labor laws and the implementations of labor market analysis for you. Work and the labor market. So obviously when we think about economics, when we think about a lot of current issues, labor's always going to come up. Labor is going to be a key component all the time, and whenever it does come up, it's really good to have some grounding on the core economic principles so that we can talk about these things intelligently when they do come up. So the labor market is a factor market in which individuals supply labor services for wages to individuals and firms demand labor. So notice we're going to have a supply and demand graph, of course, a nice supply and demand graph. But notice here it might be a little bit less intuitive because we've been talking about supply and demand in terms of the firm producing output. In this case, the individuals, us, the people, are the suppliers. We're supplying work. And the people that are demanding then are basically the firms. They're demanding work. So just, you got to kind of reverse that in your head. Same graph, same idea, going to have the same equilibrium and whatnot, concepts of equilibrium. But now the demanders, the people that are demanding, are the companies. The companies are demanding. The suppliers, the people supplying, in this case, the supplying of the work, will be us, the employees. The labor supply choice is between non-market activities and legal market activities. So when we think about we, the individuals supplying our labor, we of course in a free market have the choice to do that. Should we supply our labor or not? And we got to weigh the pros and cons. The pros being the wage, of course, we're going to get, and satisfaction and everything else from working. And the opportunity cost is what we're giving up. So we could be going to the beach. We could be playing video games at home, watching TV, or doing anything else. Also, we have the alternative of a black market. If we determine that for whatever reason the current market is not giving us a wage higher than the black market, possibly because of regulations and taxes and whatnot, then that's also an option that would be a non-market option in terms of the legal market. Incentive effect is how much a person will change hours worked in response to the change rate. So we're trying to see basically how elastic, meaning how much will the supply of work change as relation to a change in price. So as the wage goes up and down, what's going to be the effect on how much more or less we are willing to give our work as a society in relation to that change in wage rate. Economists focus on the incentive effect when considering an individual's choice of whether and how much to work. So clearly we think as economists that people respond to incentives. So if we incentivize people to do certain things and they're incentivized one way or the other, that's what's going to cause the change, and we can then measure those types of changes. So here we have our supply curve. It looks like any kind of supply curve. The difference basically being the axes now. We have the wage rate on the y-axis and the quantity, in this case the quantity of labor. Basically kind of you can think of it like hours of wages that we are going to supply. So obviously what happens here is that as the wage goes up, so for us, obviously if we wouldn't, or contrastly, if we had wages and then we got taxed basically down to zero, then the work supply would be basically zero. And then obviously if the wages go up, then we're more likely to go work because the opportunity cost of not going to work goes up, because if we went up to $100 and we didn't go to work, then we'd lose the $100. If the wage goes up to $200 and we didn't go to work, then the cost of us being on the couch or doing whatever else or going to the beach or whatever would be worth the $200. So therefore, as the potential wages go up, then of course the supply then of our work will go up. So the labor supply curve has a positive slope because the opportunity cost of not working increases as wages go up. And that's a normal looking supply curve. Again, the changes being the wage rate and the quantity of labor on the axes. So the higher wage, the higher the opportunity of labor supplied. So real world wages. So the upward sloping labor supply curve tells you that other things equal, as wages go up, the quantity of labor supplied goes up. That makes sense. As we can get more wages out there, we are willing to do more work to earn those wages. Historically, however, real wages have been increasing and people have reduced the number of hours worked. So there's kind of a contrast that we got to explain in some way historically, and we can think of a lot of times in history where the work week could be longer and the days could be longer, like 60-hour days for 6 or 7 days a week. And we can explain that by saying in part that this is explained by the income effect. So the income effect has the opposite effect of the opportunity cost that we just talked about. And remember, we talked about the opportunity cost being that if we went from $5 an hour, we'd say, I'm not sure if that's worth the quantity. If we went to $10 an hour, then we're probably willing to work more for the higher wages and the higher wages up to some point. And if at some point, however, if we have a comfortable wage, then we start to think that we want a balanced lifestyle. We want to not work all the time, even though we're giving up a large wage. We want some leisure time, and so that opportunity cost of leisure time is more valuable in that case, and therefore we're willing to actually give up some of those wages, even though they could be higher wages, in order for the leisure time. So higher income make people richer, and richer people can afford to choose more leisure time. So those are the two kind of effects that are pulling different ways that are going to explain the different trends in the supply curve, and kind of the bend of the supply curve is the interplay between those two effects, the opportunity cost and the income effect. So income tax, work, and leisure. Tax reduce the net wage of individuals, reducing the incentive to work. So this should be clear. If we're going to receive $100 and there's a 20% tax and we only get $80, then in effect it would be just like we got $80. It's not like we got $100, we got $80 on it. And if, of course, the tax was 100%, if we earned $100 and we got $0, well, that would be the same as if we got paid $0. It probably wouldn't work. As the tax goes down, then what essentially happens is our wage goes up in relation to what the tax was before. So an increase in the marginal tax rate is likely to reduce the quantity of labor. So what does that mean? It means that as taxes go up, people have less of incentive to work. So you would think that as taxes go up, there's less people that are joining into the labor market. It's going to reduce the amount of labor. So the EU countries, which have a relatively high marginal tax rate, are struggling with the problem of providing incentive for people to work. So in the EU, they actually have higher tax rates than in the US generally. And of course, as would be predicted, you would think from this model, is that people are logically saying, the opportunity cost of me working, it's not worth the time, and therefore the work that's being output is they're looking for more incentives to increase the amount of number of hours and work that will be provided. So for welfare recipients, the tax penalties for working create a great incentive not to work or to work off the books. And note, there's a lot. This doesn't mean that we shouldn't have kind of some welfare programs and some safety net programs. What it does mean is we might want to think about incentives. We always have to keep in mind what the incentives will be. And one of the negative incentives of a straight welfare plan, in that if the welfare plan says if someone is not working, then we're just going to give a straight wage until the individual starts working again. and the wage happens to be the same amount that they could receive from working, or maybe even more, you can see that obviously the incentive effect would be that they would not want to work because they might get a wage that's less or equal than the wage they're getting not working. And of course, that's going to be a problematic long term, because the longer someone's out of employment, then it could have more an effect down the road. And so the question isn't really that we don't need a safety net program, but later on we'll talk about some ideas that might be more effective and more efficient in achieving the goal being to supplement the income and incentivize people to get back into a place where they can work. And one of the ideas that are currently in place is like an earned income credit, which gives a credit for some hours worked, which actually incentivizes the incentive there being to work, not a negative incentive that's involved in this. And you can see that this actually has a rational outcome. A rational person would say, I'm better off not working in that condition than to go to work. And of course, that's a negative incentive. So the elasticity of supply. So elasticity of supply, demand, individual's opportunity cost. So elasticity, remember what elasticity is, means that as there's going to be a change in the price, how much of a related change will there be to the quantity that is going to be supplied? So elasticity of labor depends on things like individuals' opportunity costs for working. So there are other choices, what they could do instead of working. If those choices are better, if they start to look better or worse, then that will of course affect the elasticity of whether they're willing to work at different types of wages. The type of labor being discussed, so what type of labor are we going into here? The elasticities of individual supply curves. So when we think about everybody has a different supply curve, that's how we get the market supply curve. So we have to consider the differences in individual supply curves and individuals entering and leaving the labor market.